Imagine a world where the S&P 500 doesn't just hit 5,000, but rockets to 7,000. Sounds outrageous? Maybe not. With AI breakthroughs, productivity surges, and a new bull cycle underway, is this milestone closer than we think? Stay with us, because this video dives deep into one of the boldest predictions on Wall Street. Before we jump in, make sure to hit that subscribe button for weekly insights into markets, investing, and the future of finance. You don't want to miss what's coming next. Setting the stage. The S&P 500 has already stunned analysts by surpassing the 5,000 mark in early 2024. We explore what could fuel a further 40% rally to 7,000. The goal? Break down fundamentals, sentiment, and economic signals pointing toward this target. Historical growth trends. The S&P 500 has compounded at approximately 10% annually since 1957. From 2000 to 2020, despite two major crashes, it more than doubled. Recoveries from the dot-com bust, the 2008 crisis, and COVID illustrate long-term resilience. If recent AI and tech-led growth continues, 7,000 could be reached within 3 to 5 years. What's fueling the rally? Artificial intelligence and automation. NVIDIA's chips are powering everything from ChatGPT to Tesla's autonomous software. Microsoft's Copilot has redefined enterprise productivity. Productivity. Boom. Companies are reporting higher margins thanks to automation, reduced headcount, and AI-assisted operations. Corporate earnings. Q1 2025 earnings beat by 15% across tech and industrial sectors. Apple, Google, and Meta saw year-over-year revenue growth of 20 to 30%. Rate cuts and Fed. Pivot. With inflation nearing 2%, the Fed is signaling cuts in late 2025. Lower rates tend to boost valuations. Retail investors, $150 billion flowed into U.S. index funds in Q1 alone. Robinhood and Fidelity accounts have hit record levels. Bullish case for 7,000. JPMorgan and BlackRock forecast S&P 500 targets above 6,200 for 2026. Technology remains the rocket fuel. AI adoption across industries, surging cloud usage, and chip innovation. Industrials are experiencing an onshoring renaissance, boosted by AI-powered logistics. Green energy is accelerating. Tesla, Enphase, and First Solar are up over 40% YTD. Buybacks and dividends. S&P companies are on pace to return $1.5 billion trillion to shareholders this year. Sovereign wealth funds from the United Arab Emirates and Singapore are increasing allocations to U.S. equities. Psychology plays a role. FOMO, fear of missing out, is driving speculative retail interest. Bearish case. Why 7,000 may be too optimistic? The S&P's current P/E ratio is 27, significantly higher than the 10-year average of 18. Congressional gridlock and debt ceiling standoffs could rattle investors. China-U.S. tensions, Middle East instability, and Ukraine war still pose major risks. Core inflation may stall above 2.5%, forcing the Fed to hold or even raise rates again. Some argue AI's productivity boost is exaggerated and already priced into mega-cap stocks. What needs to happen to reach 7,000 sustained corporate earnings growth of 10 to 15% year over year for multiple quarters? At least 2 rate cuts to bring down the cost of capital. No major global conflict or trade war escalation. AI adoption moving beyond big tech into manufacturing, retail, and healthcare. A wave of successful IPOs like Stripe, Reddit, and SpaceX would bring new energy to markets. Sector breakdown. Who will lead? Tech. NVIDIA, AMD, and Broadcom driving semiconductor arms race. Microsoft, Amazon, and Google dominating cloud. Energy. Clean tech outpacing fossil fuel returns. Lithium miners, hydrogen, and grid tech. Finance. Goldman Sachs and JPMorgan blending fintech strategies and traditional banking. Consumer discretionary, Nike, Amazon, and travel stocks bouncing back as consumer confidence hits two-year high. Healthcare, AI diagnostics like IBM, Watson, and biotech firms using CRISPR to revolutionize treatment. Expert opinions and market sentiment. Cathie Wood predicts tech could push the market into exponential territory. Hedge fund managers on Bloomberg are torn, some hedging with gold, others going all in on tech. Reddit's Wall Street bets bullish on semiconductors and AI. Institutional buying remains strong, according to Bank of America's weekly flow data. Analysts see high dispersion, meaning not all stocks will rise equally. Investing strategies in a rising market dollar cost averaging helps reduce timing risk. Great for ETFs like VOO and QQQ. Lump sum investing can beat DCA during strong bull trends. Focus on sector ETFs, XLK, Tech, XLF, Finance, XLV, Healthcare. Diversify with dividend aristocrats, Coca-Cola, Procter & Gamble, Johnson & Johnson. Mix growth and income, own Amazon for growth and Verizon for yield. Warning signs to watch, RSI and MACD showing overbought conditions on major indices. Margin debt surpassed 2021 levels, increasing risk of liquidation-driven sell-offs. Insider selling up 40% compared to the start of 2024. Parallels to the 1999 bubble, tech-heavy index, speculative IPOs, retail frenzy. Viewer poll and call to action. Do you think the S&P 500 can hit 7,000 by 2027? Drop your predictions in the comments. And don't forget to subscribe for weekly deep dives into markets, finance, and economics. Thanks for watching. Whether you're a bull or a bear, one thing is clear. Markets are evolving fast. And here on your channel name, we're tracking every step. Subscribe, like, and share. And we'll see you in the next video.